ready to crack Wall Street's code. We're going deep into Peter Lynch's one-up on Wall Street to see if maybe you, you, can use his tricks to be a smarter investor.
It's wild how Lynch flips the script. Instead of depending on those Wall Street hotshots, he thinks everyday folks like us have got the edge.
Right. He calls us the dumb money. But he's really saying we're bumping into potential gold mines all the time before the big guys even notice. Think about it. You've probably walked right past a dozen 10-baggers without a clue.
Totally. He uses that example of the limited. Back then, you might have just seen it as some trendy clothes store at the mall. But someone who was really looking could have seen a company ready to explode.
So how do we actually use this local knowledge thing? If I see a packed restaurant, does that automatically mean it's a good investment?
Not exactly. It's about putting the pieces together. Say you see that local coffee shop is always jammed, and they're starting to open new spots. That's a growth sign right there. Then you dig a little deeper, find out they've got some unique loyalty program or a special brewing method that sets them apart. Suddenly, you're not just getting a latte, you're spotting a possible investment.
Makes sense. It's like looking past the surface and figuring out what makes a business work.
Absolutely. And Lynch gives us a way to do that with his 6 categories of stocks: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays.
Well, that sounds kind of overwhelming.
Yeah.
How can we use these categories for our own investing?
Well, think about picking a ride at an amusement park. Are you a roller coaster junkie, drawn to those high-risk, high-reward fast growers? Or do you prefer a nice, slow, steady ride with the reliable stalwarts? Figuring out your investor personality helps you zero in on the categories that fit your goals. And your risk tolerance.
So if I want steady growth without too much risk, I might focus on those stalwarts. But if I'm feeling a little bolder, ready for more potential upside, I might check out those fast growers.
Exactly. And Lynch gives us some pretty cool and sometimes surprising ways to spot those winners, especially those fast growers. Forget chasing the latest hot stock tip. Lynch says the best companies might be the ones nobody's talking about yet.
Like those boring companies he mentions. Why would anyone invest in something that sounds, well, boring?
That's where Lynch really challenges what we think we know. He says boring can actually be a good thing, because it usually means the company is under the radar, quietly making money without attracting all that Wall Street attention, like Crown, Cork, and Seal, the company that makes bottle caps. Not exactly glamorous, right? But a steady money-making business.
I never thought I'd get excited about bottle caps, but hey, if it's a good investment.
Right. And here's another one of Lynch's gems. Look for companies with a whisper of negativity around them.
Wait, negativity, isn't that a bad sign?
Not always. Lynch says a little negativity can actually keep the stock price down, making it a possible steal for smart investors. It's about seeing past all the noise and realizing that temporary problems don't always reflect a company's true potential.
So we're looking for those hidden gems, companies with solid track records that might be temporarily undervalued. But how do we know if a company is really a good investment?
That's where Lynch really emphasizes the importance of earnings. He says a company's earnings are the basis of its value.
Okay, earnings make sense, but I always get tripped up by those PE ratios. What's the easiest way to understand those?
Think of the PE ratio like a price tag. It tells you how much investors are willing to pay for every dollar of earnings. A high PE ratio might mean investors are really excited about the company's future growth, while a low PE could mean it's undervalued.
So a PE of 30 would mean investors are paying 30 times the company's earnings per share for that stock. That sounds pretty pricey. Would a lower PE always be the better deal then?
Not necessarily. It's all about context. A fast-growing company might justify a higher PE because investors expect those earnings to keep growing fast. But if a company has a super high PE ratio and their growth is slowing down, that could be a warning sign.
So it's like anything else. We can't just look at one number alone. We need to get the whole story behind it.
Exactly. It's about connecting the dots. Just like with that local knowledge thing we were talking about, PE ratios, earnings, growth potential, the company story, they all paint a picture of whether a company is worth investing in.
And speaking of stories, Lynch has some pretty colorful ways of doing his research. He's not just sitting in an office crunching numbers, is he?
Oh, definitely not. He's famous for his unusual methods. He'll go into stores, talk to employees, even try out the competition's products. He got the idea to invest in Taco Bell just from seeing how packed their restaurants were, you know?
Like he's turning everyday life into his own personal research lab. I love that he encourages us to do the same. We don't need some fancy Bloomberg terminal to find great investments.
You got it. Valuable information is all around us. But research isn't just about finding winners. Lynch has a whole chapter about knowing when to sell. He says it's just as important as buying.
Okay, so when should we sell? I know some people try to time the market, but Lynch isn't a fan of that, right?
Exactly. He says don't try to predict those short-term market swings. Instead, focus on changes in the company's story. Remember those 6 categories we talked about? Each one has its own signs that might tell you it's time to let go.
Give me an example. Say I've invested in a stalwart, like a good, solid, blue-chip company. What should I be watching out for?
With stalwarts, Lynch really keeps an eye on that PE ratio. If it gets too high compared to how fast the company's growing, it might be a sign the stock is getting overpriced. Think about it like this. You wouldn't want to pay a luxury price for a car that's only going to give you average performance.
So if that PE ratio starts creeping up and the company's growth isn't keeping up, it might be time to rethink that investment. What about those high-growth, fast growers then?
Fast growers are all about momentum. You're betting on them continuing to expand quickly. But if that growth starts to fizzle out, it's often a sign the company's best days might be over.
So even though I might be tempted to hold on and hope for things to turn around, Lynch would say it's smarter to cut my losses and move on to a company with stronger growth potential.
Yeah.
Makes sense. What about those other categories then?
Well, cyclicals are interesting. Their performance tends to go up and down with the economy. So timing is key. You want to buy them when their business is on the upswing and sell before it peaks.
It's like catching a wave at just the right moment.
Mm.
And what about turnarounds? Those companies trying to get back on track.
With turnarounds, you're looking for progress. Are they making real changes? Are they fixing the problems that got them in trouble? If not, it might be time to walk away.
So it's about being realistic. And finally, we have those asset plays.
Asset plays are about finding hidden value. Maybe the company has real estate or patents that the market isn't fully recognizing yet. Once that value is unlocked through a sale or better operations, it might be time to sell.
So whether it's a change in growth, a shift in the PE ratio, or a company just reaching its full potential, Lynch gives us a framework for knowing when to sell. It's like he's saying, don't fall in love with a company. Stay informed, stay objective, and be ready to move on when the story changes.
Exactly. You know, one of the things that makes Lynch so relatable is that he's not afraid to talk about his own screw-ups. He even has a whole section in the book about debunking some of the most dangerous things people say about stock prices.
You mean those common investing myths we've all heard, like it can't go any lower, or it's already gone up so much it has to keep going up?
Those are the ones. Lynch calls them reckless pronouncements and uses real-life examples to show how believing them can be a disaster. He talked about how even experienced investors can get swept up in the hype or let their emotions get in the way of making smart decisions.
So it's about staying grounded, focusing on the facts, and not getting caught up in all the emotional ups and downs.
Precisely. You know, Lynch compares the stock market to a manic depressive, swinging from super happy to super sad. He says we shouldn't get sucked into those mood swings.
So we need to have that long-term perspective. Don't panic when the market drops, and don't get too greedy when it's doing great.
Exactly. It's like weathering a storm. There will be rough patches. But if you've invested in solid companies with good fundamentals, you'll come out stronger in the end.
I like that. It's about trusting the process and not letting those short-term bumps throw us off track from our long-term goals. But let's face it, even with all the research and good intentions, investing can be a little scary, especially for someone who's just starting out.
I get that. But Lynch has a message for those who are feeling overwhelmed. You don't have to be a financial whiz to be a successful investor. He really believes that anyone can do this.
That's good to hear. But where do we even start? Lynch throws a lot of information at us.
He does. But it all boils down to a few key ideas. First, start paying attention. Engage with the world around you. Look for businesses that are solving problems, meeting needs, and growing.
So that local knowledge idea comes into play again.
Exactly. Then start digging deeper. Read company reports, industry publications, analyst opinions. Try to understand the company's competition, their management team, their financials.
It's being a detective, putting together clues to see if a company is worth our investment.
I love that. And remember, it's a process. You won't become an expert overnight. Be patient, be persistent, and most importantly, be curious.
So it's about embracing that journey of discovery, learning as we go. But I think some people might worry that they don't have enough money to get started.
That's a common worry. But Lynch says you don't need a fortune to start investing. He encourages people to start small, even with just a few bucks a week, and develop the habit of saving and investing consistently.
So it's about taking those first steps, no matter how small, and building momentum over time.
Right. And remember, time is on your side. The earlier you start, the more time your investments have to grow and compound.
So even if you're just starting out in your career, don't wait to start investing. Every little bit counts. It's amazing how Lynch makes investing seem accessible and even kind of exciting. He takes this complex world and breaks it down into something we can all understand and use.
That's one of the things I admire most about his approach. He empowers us to take control of our financial futures instead of relying on those Wall Street gurus.
Yeah.
We're getting lost in all that financial mumbo-jumbo.
You know, one thing that really stood out to me was Lynch's focus on the long game. He's not about chasing quick wins or trying to time the market. He's all about finding those great companies and sticking with them.
He really drives home the point that real wealth is built over time. He even uses that analogy of planting a tree. You wouldn't dig it up every few weeks to see if it's growing, right? You take care of it, give it time, and let it grow.
Love that. It's about having the patience to let those investments grow and not freaking out when the market inevitably dips. But I think one of the biggest fears people have is making a mistake. What does Lynch say about those inevitable investment blunders?
He's surprisingly open about his own mistakes. He even has a section in the book called his Investing Hall of Shame, where he talks about some of his biggest flops. He's not afraid to admit he doesn't always get it right.
That's refreshing. It makes him seem more human, more relatable. So it's okay to mess up as long as we learn from it.
Exactly. He sees mistakes as opportunities to learn. He says we should analyze what went wrong, figure out why we made the choices we did, and use that knowledge to make better choices next time.
Like that saying, every master was once a disaster. We're going to trip up along the way. But it's how we get back up and keep learning that matters. But let's talk about that invest in what you know idea. Sounds good in theory, but how do we actually do it?
Think about your own life, your job, your hobbies, the stuff you use every day. What companies make those things? Are any of them showing signs of growth or doing something new and innovative? Are they solving problems in a unique way?
So if I'm a total coffee nut, always trying new blends and brewing methods, maybe I should be looking at coffee companies. Or those trendy coffee shops popping up everywhere. Or if I'm a gamer who spends hours in virtual worlds, maybe I should be paying attention to video game developers or streaming platforms.
Exactly. You're already part of those worlds. You understand the trends. You know what people want. That's valuable insight. Lynch encourages us to use that knowledge and become amateur experts in the areas that interest us.
It's like turning our passions into investment opportunities. But what about those of us who don't feel like we have any real areas of expertise? Where do we begin?
Lynch would say, start exploring. Read industry magazines, go to trade shows, talk to people in different fields. Be curious, ask questions, and see what catches your eye. You might be surprised by what you find.
It's about opening ourselves up to new possibilities and realizing that investment opportunities can come from anywhere. But in the end, what's the one thing Lynch really wants us to remember?
I think it's this. Investing isn't just for Wall Street bigwigs. It's a powerful tool that anyone can use to build wealth, achieve financial freedom, and create a better future for themselves and their families.
He's a real advocate for the everyday investor. He believes in us, even when we doubt ourselves. So as we wrap up this deep dive, what's the final thought you want to leave our listeners with?
Keep it simple. Don't be scared. Don't let fear or lack of experience hold you back. Take that first step. Embrace the challenge and start investing in your future today. You have the power to make it happen.
That's a great note to end on. Thanks for joining us on this journey through Peter Lynch's One Up on Wall Street. We hope you've learned some valuable things and feel inspired to take charge of your financial future. Until next time, happy investing. It's like he's saying we can all be investors. We don't need some fancy degree or connections.
Right, and that's what makes Lynch so different. He breaks down those Wall Street walls and says, hey, you can do this too.
Okay, so let's dive into some of his specific strategies. One thing that really stood out to me was his emphasis on finding those 10-baggers, stocks that go up 10 times their original value.
Ah, yes, the elusive 10-baggers. Lynch's holy grail of investing.
So how do we spot these magical creatures in the wild?
Well, Lynch says it's all about identifying companies with huge growth potential, companies that are on the verge of something big.
But isn't that what everyone on Wall Street is trying to do?
Sure, the pros are always looking for those high-growth companies, but Lynch argues that everyday investors have a secret weapon.
What's that?
It's that local knowledge we were talking about earlier, that firsthand experience that gives us an edge.
So we're not just looking at numbers on a spreadsheet. We're actually out in the world observing, interacting, and noticing things.
Exactly. Lynch famously invested in Dunkin' Donuts because he saw how popular their coffee was. He noticed the lines out the door, the loyal customers coming back day after day.
He literally followed his taste buds to a 10-bagger.
He did. And that's the beauty of it. You don't need some complex algorithm or insider information. Just keep your eyes open and pay attention to what's happening around you.
So if I see a new restaurant that's always packed,
Hmm.
or a local business that's expanding like crazy, that could be a sign of a potential 10-bagger.
It could be. But it's not just about popularity. Lynch says you need to dig deeper. Look beyond the hype and understand the company's story.
Okay, so how do we actually do that? What are some of the questions we should be asking?
Lynch gives us a whole checklist of things to consider. He calls it his 20-point checklist.
20 points sounds a little intense.
It is comprehensive, but don't worry, we don't have to memorize all 20 points. The key is to focus on the factors that matter most to you.
So let's break down a few of those key points. What's the first thing we should look at?
Well, Lynch always starts with earnings. He says a company's earnings are like the foundation of a house. If the foundation is weak, the whole structure is unstable.
So we want to see consistent earnings growth.
Ideally, yes, but Lynch also recognizes that not all companies grow at the same pace. He has those 6 categories of stocks we mentioned earlier. Each one has its own earnings patterns.
Right, those slow growers, stalwarts, fast growers, and all that.
Exactly. You need to adjust your earnings expectations based on the type of company you're looking at.
So a fast grower might have explosive earnings growth early on, while a stalwart might have slower, more steady growth.
Exactly. It's all about context.
Okay, so we've looked at earnings. What's next on Lynch's checklist?
Another important factor is debt. How much debt does the company have, and how easily can they handle it?
Too much debt can be a red flag.
It can be, especially if the company's earnings aren't strong enough to cover the interest payments.
It's like having a mortgage you can't afford.
Exactly. You don't want to see a company drowning in debt.
Okay, earnings, debt. What else should we be paying attention to?
Lynch also talks a lot about the PE ratio. That's the price to earnings ratio.
Yeah, I've heard of that, but I'm still not entirely sure what it means.
Simply put, the PE ratio tells you how much investors are willing to pay for each dollar of earnings. A high PE ratio could mean the stock is overvalued, while a low PE ratio could suggest it's a bargain.
So it's like a measure of how expensive the stock is.
You could say that, but Lynch cautions against using the PE ratio in isolation. You need to consider it in the context of the company's growth prospects, industry, and overall market conditions.
Right, it's all about connecting the dots.
Yeah.
Just like with our local knowledge example.
Exactly.
Okay, we've covered earnings, debt, and the PE ratio. What else is on Lynch's checklist?
Well, he also looks at things like insider buying.
What's insider buying?
That's when company executives and directors buy shares of their own stock.
Why is that a good sign?
Well, who knows a company better than the people running it? If they're buying shares, it could be a sign that they're confident about the future.
So they're putting their money where their mouth is.
Exactly.
What else does Lynch look for?
He also likes to see companies with a strong track record of dividends. Dividends are those regular payments that companies make to their shareholders.
So it's like getting a little bonus for owning the stock.
You could say that. Dividends can be a sign of a company's financial health and its commitment to returning value to shareholders.
Okay, so we've got earnings, debt, PE ratio, insider buying, dividends. That's a lot to keep in mind.
It is. But remember, you don't have to be an expert in everything. The key is to focus on the factors that you understand and that are most relevant to your investment goals.
And Lynch really emphasizes that we should be doing our own research, right?
Absolutely. He encourages investors to become amateur sleuths, to dig into company reports, read industry publications, talk to analysts, and even visit stores and try out products.
So it's not just about reading headlines and following the crowd.
No, it's about developing your own informed opinions.
And being able to make your own investment decisions.
Exactly.
Lynch really empowers us to take control of our financial futures, doesn't he?
He does. He believes that anyone can be a successful investor, as long as they're willing to put in the time and effort.
It's inspiring, really. But even with all the research in the world, I think a lot of people still struggle with the emotional side of investing.
Yeah, that's a big one. Fear and greed can really cloud our judgment.
So how do we avoid letting our emotions get the best of us?
Well, Lynch has some great advice on that. He says we need to develop a long-term perspective.
Don't get caught up in the day-to-day fluctuations of the market.
Exactly. Remember, the stock market is like a roller coaster. It's going to have its ups and downs.
But if you've done your research and you're invested in solid companies,
You can ride out those bumps and come out ahead in the long run.
so it's about having a plan and sticking to it.
Right. Don't panic sell when the market dips. And don't get too greedy when it's soaring.
Stay focused on your goals.
And remember why you invested in the first place.
Makes sense. Any other tips on managing those emotions?
Well, Lynch also suggests diversifying your portfolio.
Don't put all your eggs in one basket.
Exactly. By spreading your investments across different companies and industries, you can reduce your risk and potentially increase your returns.
So even if one investment doesn't pan out,
The others can help cushion the blow.
I like that. It's like having a safety net.
It is. And another thing that can help is having a clear understanding of your risk tolerance.
How much risk are you comfortable taking on?
Exactly. Some people are thrill seekers. They're comfortable with high-risk, high-reward investments.
Like those fast growers we talked about earlier.
Right. Others prefer a more conservative approach.
They're happier with slow and steady growth.
Exactly. There's no right or wrong answer. It's about finding what works best for you.
And being honest with yourself about how much risk you can handle.
Absolutely.
Okay, so we've covered a lot of ground here. From identifying potential 10-baggers to managing our emotions. What's the one big takeaway you hope our listeners will walk away with?
I think the biggest lesson from Peter Lynch is that investing doesn't have to be complicated or intimidating. With a little bit of knowledge, effort, and patience, anyone can become a successful investor.
He really democratizes investing, doesn't he?
He does. He takes it out of the hands of the elites and puts it within reach of everyone.
It's empowering, really.
It is.
And it's a message that resonates with me.
Me too.
Okay, so we've talked a lot about finding those winning stocks. But even the best investors make mistakes. What does Lynch say about dealing with those inevitable blunders?
He's actually pretty upfront about it. He even has a whole section in the book called his Wall Street Wreckage, where he talks about some of his biggest investing flops.
So he's not afraid to admit he's messed up.
Not at all. He actually embraces those mistakes. He says they're some of the best learning experiences you can have.
So it's not about being perfect. It's about learning from those blunders and getting better over time.
Exactly. And, one of the things that makes Lynch such a great teacher is that he doesn't sugarcoat things. He tells it like it is. He warns us about the common pitfalls that investors fall into.
Like what?
Wow. One of the biggest mistakes he sees investors make is getting too caught up in the hype.
Buying into those hot stocks that everyone's talking about.
Exactly. He says we need to be wary of those story stocks, the ones with a compelling narrative, but maybe not the strongest fundamentals.
So a company might have a great product or a charismatic CEO, but if the numbers don't add up, it's probably best to stay away.
Exactly. Don't get blinded by the hype.
Do your research, look at the financial.
And make sure the story matches the numbers.
Makes sense. Any other common traps we should watch out for?
Well, Lynch also cautions against trying to time the market.
Trying to predict those short-term ups and downs.
Exactly. He says it's practically impossible to consistently buy at the bottom and sell at the top.
So instead of trying to time the market, we should focus on finding great companies.
And holding on to them for the long haul.
Exactly. Remember that tree analogy we talked about earlier?
Right. Plant those seeds, nurture them, and let them grow.
Don't keep digging them up to see if they're sprouting.
Exactly.
Okay, so we've learned a lot from Peter Lynch about finding winning stocks, managing our emotions, and avoiding common pitfalls. What's the one message you think he'd want our listeners to take away from all of this?
I think he'd want us to remember that investing isn't just for the wealthy or the well-connected. It's something that anyone can do with a little bit of effort and the right mindset.
He's really a champion for the everyday investor.
He is. He believes that anyone can achieve financial freedom if they're willing to take control of their finances and invest in their future.
And that's a powerful message.
It is.
Well, I think we've covered just about everything.
I think so.
Thanks for taking us on this deep dive into Peter Lynch's One-Up on Wall Street.
My pleasure.
It's been a fascinating journey.
It has.
And we hope our listeners have learned some valuable lessons along the way.
Me too.
We'll see you next time for another deep dive into the world of investing.
Sounds good.
Until then, happy investing.